and welcome to another edition of the Nerdy Agent Podcast. I'm your host, Luke Pettersen, alongside my brothers and fellow nerds, Josh and AJ. We are in a different location today. We went to the Fishbowl.
It's a new location.
I still think long-term, this table gets removed. We maybe hold the mics or we get stands because I want to sit back. Yeah, I want to kind of lean back and relax. I also have another special thing that I brought along today. With October comes the best time of the year, and that means the Advisory Realty Group basketball team is back in action, folks. Defending Bronze League champions have their opening season scrimmage tonight. We're going to roll out a smooth 5 or 6 players, which is very standard for what we're looking for. So everybody get excited. Let's get a photo of that one.
So we obviously do this podcast to make sure we bring as much value as possible to other agents, and some people have joined our team and they would like to hang out with us because of different things. But I think probably the basketball team is the reason why most people want to join the team.
Biggest value add.
Yeah, we actually have. So we're at 35 agents.
So if you're a terrible agent and you have no interest in getting better, but you want to play basketball,
no, hold on. But you're very tall because we're short right now. We're very short.
But also, if you're there's tryouts. So you try out, and unfortunately,
everyone
only
makes
about
the team.
10% of the players get on. No, I'm kidding. It's not very strict. If you want to play basketball, you can join the team.
But we are the champions.
But we are the champions of the Bronze League. They even tried to get us to move up to silver, but we said, no, we're trying to do-meet. Okay.
We know where we belong.
So this week, we are going to talk about kind of just a recap on what's going on in the economic environment of things with the federal funds overnight rate, the yield curves, 30-year mortgage rates, what they've been looking like, what buy-downs are looking like right now. We should probably talk about ARMs a little bit, I think would be helpful. But first, we are going to have a Would You Rather of the week that I'm going to pull off of this list. And the question is, would you rather have a giant indoor trampoline, a house with a giant indoor trampoline, or a house with a giant indoor slide?
I kind of already have a trampoline. We have one of those bouncy houses.
Yeah, we have one too.
Is it giant?
It's not giant.
Not giant.
It's enough for 3 or 4 kids.
Children, yeah.
I'd like to have a slide from the primary bedroom upstairs all the way to the basement sport court.
That would be fun. I think
that be
that's
fun?
code violation, Luke.
Is it?
Fire blocking.
Seems like they need to fix they need to fix the code.
You could have a little piece there that you hit through at the end. You know, and it
Oh, okay.
Like
Might have to have it on
gap on a plumbing.
In St. Louis Park, you would need 6 of them.
I don't think would you rather's really, are determined by whether or not codes
I'm just
are acceptable.
saying, I'm a code guy.
Yeah. Well, a trampoline indoors is probably a safety hazard too.
It's not great, no.
But if it's like one of those trampoline parks that you go to, where like a whole area is just pure trampolines, and you have like basketball hoops you can dunk on, and you've got like foam pits, I think I'd go trampoline.
It's fun.
That'd be kind of fun. Nice. All right, well, let's get into what actually matters to the listeners. We have to every week get in kind of our own comments because otherwise we'll get really bored. So we got to add that stuff in there. To start, can you guys, we chatted about this back when we initially talked about the federal funds rate and what it was. Can you just remind them why it matters to track this and be able to talk about it properly with your clients?
Yeah, so, the federal funds rate is the rate...
And what it is, yeah.
The rate set by the Federal Reserve for overnight lending between banks. It is correlated with mortgage rates in that a lot of other behaviors are impacted by what the Fed decides to do. So when people say the Fed is raising rates or they're lowering rates, it does not necessarily mean that your mortgage is going to go up when they raise rates or go down. But the behavior the Fed does or makes, the changes they make, as well as the expectations of future changes they make, will impact primarily the 10-year Treasury. So as these rates go up, your Treasury yields are going to go up, and then that's going to tend to result in mortgage rates going up as a result. So 10-year Treasury and 30-year fixed mortgage rates are very highly correlated. And the federal funds, the expectations of where the Fed is going to raise or change the federal funds rates to will impact how the 10-year Treasury yield goes up or down. So right now, there's expectations of what's going to happen at the next Fed meeting. If something comes out that suggests that the Fed's behavior is going to be different than what is expected today, then that 10-year will go up, and thus you'll see mortgage rates tend to rise accordingly.
And we have seen sometimes, though, in the past, just to make sure people understand why there's not a direct correlation between the federal funds rate and the 30-year mortgages, is sometimes the expectation is going to be they're going to raise it a lot, let's just say that one meeting, and then they raise it not as much as the expectation was, and they still raised that, but it still could then cause the rate to come down on the back end because they've already built in the fact that they thought they were going to raise it a lot.
Everything's based on expectations. Yep. So the traders are making decisions on a daily basis with stocks based on expectations. This kind of acts similarly, where if they say rate's going to go up 50 basis points, they're already pricing that into everything. So if the rate doesn't go up 50 basis points, even if it goes up 25 basis points, mortgage rates will likely fall in that scenario.
That's like when I always love when I go on social media and there's an agent out there that's saying, the Fed's raising the mortgage rates. And I'm like, that's not really what's happening. They don't do that. But for those that don't understand banking, the reason why these are heavily correlated is banks don't have most of your money. They're actually loaning money to loan it out to you, and they have to make money when they do that in order to be a profitable company. So when the Fed funds rate is at, say, today's rate of 5.25 to 5.5 overnight rate, they have to loan out money at a higher number than that in order to make money at its simplest form. It's a lot more complex than that. But
if you borrowed money from Luke at 5.3% and then you loaned it to me at 4.6%, you would be losing money.
You're a bad bank.
Bad bank.
So just before we get into kind of what the numbers are actually looking like right now, where can people track this if they haven't seen the other podcast?
You can Google overnight federal funds rate, and it will tell you. I just did it. It's right there. It's 5.25 to 5.5. CNBC is a great spot to track the 10-year Treasury yield. I do it a few times a day just to see where it's trending.
I'm looking at it right now.
Here we go.
It makes me sad most days.
A lot of the other mortgage numbers can be found at the St. Louis Fed.
Mortgage News Daily is going to have your average rate.
Par rate went over 8% today.
Par rate's over 8?
Flat 8.
Flat 8.
There's actually, to keep it as simple as possible, there's actually an app. It's called Mortgage News Daily. You download the app.
Updates.
You literally open it and it just says 30-year fixed 8%, 15-year fixed 7.29.
Or if you're old like me and like computers and don't have a million gigabytes of storage for all the apps that people have these days, you could just go online too.
To the website.
TheMortgageNewsDaily.com.
To the website, the World Wide Web.
But I'm old, so my phone's out of storage.
Josh is like 40 maybe.
I'm almost 40, Luke.
Okay, so AJ already talked about it, but overnight rate, what's it been doing the last, let's say, 3 to 6 months? Where's it at today?
3 to 6 months, I think it was in the 4s 6 months ago. But the expectation was that it was going to get to the rate that it's actually at today. I want to say that most folks were seeing low 5s was where they were going to be the terminal rate, I think is what they call it, which is the final number they get to. So it's 5.25 to 5.5 right now.
Final number they get to at the top before they start holding it there and then cutting.
Or cutting, yeah.
Or cutting.
But right now,
what's
what we've seen is we've seen a 10-year rise the last 2 to 3 days pretty dramatically. The biggest reason for that is when we start to see some of the data come out, like the PPI came out and that was higher than we had anticipated. And then obviously there's wars going on in the world that's causing some uncertainty. There's just different things that are causing these rates to rise at the moment. And so right now the Fed continues to be really tight-lipped about where they're going to go. And they always seem to be throwing out these like, well, maybe, which is causing investor uncertainty, which continues to rise the rates.
The next Fed meeting is the expectation they're going to raise it again, or is it the expectation they're going to hold it?
The conflict in Palestine and Israel has actually caused some people to say, let's maybe not do anything right now because we want to see what plays out there.
We saw pullback in the Fed funds or the 10-year treasuries for a couple days
because of it.
Yep, but I don't know. It'll be interesting to see what they do at the next meeting after all of that. I think the consensus was they were going to raise it by 1/4 point before all of that happened, and now they're trying to figure out what to do.
So now that's the overnight rate. The next one we like to talk about is the 10-year, and then how that affects the 30. You already talked about the 10-year a little bit. What is that? What are those looking like right now?
The 10-year yield?
Yeah.
4.91. Highest reading we've had since 2007, I want to say.
It's just crazy.
So it's moved up fairly sharply. You typically see this, and we bring up financial advisor Alex every once in a while on the podcast, which he brought to me to light of as soon as the Fed signals that they're done raising rates, every other tightening cycle, when they say we're done, the 10-year treasury yield gets absolutely annihilated because bond traders are more focused on their paper value of the bonds than the actual rate of return. So they're like, that's fine. I'm going to make 4.9% over 10 years. That's whatever. That's fine. But if you get a 4.9 coupon today and tomorrow it's 3.5%, your coupon is worth a ton more money. Like your $100 is worth $150 now. Mm-hmm. So there's a paper value on every bond as well. And when the bond that you hold is at a much higher number than the current treasury rate, your bond is worth a lot more than what you paid for it. So
It's kind of like houses.
And right now,
You buy it at a certain price, and then over time it changes price based on market conditions and dynamics.
And right now, that would be what's called an inverted yield curve in the sense that you have that bond, but the overnight rate's higher.
No, the inverted yield curve is typically the 2-year versus the 10-year. So the interesting thing about that is it follows similar cycles, and it follows similar cycles especially when it comes to recessions. So a yield curve inversion has predicted, I think, 20 of the previous 5 recessions. Does that make sense? So it's happened 20 times. Not really, actually. It really doesn't invert that much. That's the joke that people always make.
Every time there has been a recession, there has been an inverted yield curve.
Yes.
But not every inverted yield curve means there's a recession.
Exactly. And I'm looking at the chart now, and it has happened. I think it's like probably 8 of the last 5 recessions. So it's happened 3 more times where we didn't actually have a recession. Notably in a similar economy back in the 80s when it was really screwy. That being said, the yield curve inversion has started to uncouple quite a bit. So it got as big as 100 basis points. So that means the 10-year yield was 100 basis points below the 2-year yield.
Or one full percentage point.
1 full percentage point. So 5% for the 2-year would be 4% for the 10-year.
What are they at right now?
Right now it's at about 0.31%. So it started to uncouple. Every single recession on the chart I'm staring at right now, when the curve actually was not inverted anymore, almost at the moment that it uninverted. Is that the right word? Diverted?
Uninverted.
Uninverted.
Right.
Okay.
It inverted.
It verted. At the moment that it uninverted, was the start of the recession. So you look at the 80s were weird, but it did happen then too. But the lines were just really, really, really stark. If you look at early 1990s recession, as soon as the yield curve uninverted, recession started. You look at the dot-com crash recession, same thing. You look at 2008, same thing. You look at 2020 on a smaller scale, same thing. And you look at now, it's starting to happen. So we're getting close. In fact, if we make up how much we've made up in the past July, August, September, in the last 4 months, the yield curve will be fully uninverted within 3 to 4 months. Mm-hmm. So by January, February, you would see it's fully uninverted. That's probably when they would signal, now's the time the recession happened, based on the charts.
Mm-hmm.
What would it mean if that happened and the recession was signaled? Does that mean anything like substantial to the real estate market?
That's a great question. I mean, you when that happens, you're probably in an environment where the Fed is no longer raising rates because there's less short-term uncertainty. So that's when recession, they say that's when it happened. There's less short-term uncertainty now. We know that we're in a bad time and it's going to get better, right? That's typically kind of how that goes. That's when those yields start to get bought up fast, right? So people try and rush in and be at the top rate so that their bond value is really, really high. And that's what sends those yields down. That's what sends mortgage rates down.
Because it's a supply and demand thing, right? So demand increases. And when demand increases, the
price goes down.
And by the way, the Fed controls a lot of the bond market, so specifically mortgage-backed securities. So there's a lot more complex things that go on in the back end there. But right now they're a seller, so that is going to cause those yield spreads to be higher. So the 30-year fixed rate from the 10-year yield is really wide right now.
If you really think about it, the weird thing about this, when to make in your brain, is the Fed is doing things to try to mitigate inflation, right? Inflation ran wild and they're trying to tamp it down. So that's why they're raising this rate. And that's why they're essentially trying to, in essence, create recessionary type environments. If we get to the point where we've created a recession, what AJ's saying is that in essence means the Fed has done their job, right? So if we get to the point where they're there, they don't need to create more pain. They've already created enough pain for us to get back to a point where our inflation numbers are back where they want them to be. So that will signal typically a stop to a raise in the overnight and potentially then starting to peel that onion back. If that happens, that will push through on everything else, and thus the 10-year will come down. The 30-year mortgage rates would actually start to come back down once we get to the point. So it sounds bad to say, well, a recession actually means probably positive things for mortgage rates, but that's likely how behaviorally things will play out if we get to the point where people say, yes, we're actually in a recession now.
Unfortunately and fortunately for the people that own houses, I don't think it's going to lead to a lot more inventory. So we're still going to be in this weird environment where not a lot of homes are on the market. But for agents listening, it might mean a lot more buyers interested in buying homes and a lot higher transaction counts than we have right now.
Maybe. Yeah.
It's going to be very hard to predict, I would say. But when you do see the headline that says, oh no, we're going into a recession, like Josh kind of pointed out there, it's not necessarily that the world's going to end. It actually is maybe a signal that things are going to go the other direction.
From a real estate market standpoint.
Exactly,
yes.
Which is important because a lot of our listeners are real estate agents. I just want to talk about, I'm just adding this in here just because we're talking about rates, talking about a lot of this. So the rate right now is about 8. That's what I'm seeing on Mortgage News Daily, 8% today. A lot of people are talking about rate buy downs. And so I just want to run through those, whether it's straight buy down by the buyer, or the 2-1, 3-2-1 buy downs that sellers pay for.
There's a lot of different options. A standard buy down, the only thing I caution anyone who's looking at that right now, because people might want to get their payment to a level that they feel comfortable with, and with the rates being as high as they are, that's driving payments up. The only thing to be cautious about there is looking at what I call the payback period. So if you're just making up a number, but if your buy down is going to cost you $5,000 and it saves you $100 a month, then you're taking a 50-month payback period on that. Payback periods are at shorter cycles right now because the expectation is that rates will go down. So the banks are more comfortable, or the lenders are more comfortable shortening those because they get their money up front and they think you're going to refi out of that rate anyway in the future. But do the math in your head and say, okay, if it's going to take me 50 months, I pay this cash up front, and then I get it back over the course of the next 50 months with zero interest, then when am I going to potentially be refinancing? Does this number make sense in my head? And am I just paying a lot more money up front to get a lower monthly payment when I could just hold on to that money, put it into a 5% interest bearing money market account, and then just pay that extra $100 a month towards the mortgage anyways, or something along those lines, right? So there's ways to think about it, but I wouldn't get I have clients who get hung up on the payment amount that they're willing to do some things with cash that don't make sense. So it's always good to at least have that conversation to them so they understand exactly how they're thinking about that. 2-1 buy downs are a little bit different.
A 2-1 buy down has to come from the seller. It would buy the rate down 2% the first year, 1% the second year. If you refinance, most of those actually get whatever's left in that account. It's called an escrow account. It just goes into a principal reduction at the refinance. So you don't lose the money, right? Like if you put $5,000 in and then you refi in 6 months on a permanent buy down and you've only recaptured $1,000 worth of payments because your rate was lower, the other $4,000 just kind of goes poof.
Yeah, the 2-1, if you're married to the concept or you need it to qualify, is a much better option.
You can't use it to qualify.
Or sorry,
you need it for the payment.
For the payment.
You need it for the payment.
It's a much better option.
So here's the piece about the 2-1 buy down that my lender always just points out to make sure people understand. The seller is in that scenario. So let's say you buy it down yourself and the capture rate is 6 months and you're going to live there for 2 years. So you make what you paid for that rate buy down in the first 6 months. Everything after that, you're actually making money because you bought it down and your payment's less, right? 6 months is not going to happen, but in that
if you can do it,
if you can do it in a 2-1 buy down, if you save $5,000 the first year and $3,000 the second year in payments, the sellers are just putting $8,000 into an escrow account so that each month when that payment comes due, it saves you that exact amount of money. So it's a wash on the amount of money as far as what they're giving and what you're getting. In that same situation, you could have just had them give you $8,000 towards closing costs, not used it in cash, and you could have taken that $8,000 in cash and put it in a CD for 24 months at 5%.
Not 24, 6 months is the best rate right now.
Sure, you could put it in 4 times at 6 months, and you would be making more money in that scenario. You just have to be comfortable having the money for the payment.
Yes.
So it's
most people can't understand that concept.
It's hard.
It's fairly complicated.
Really important to make sure that you have good lenders that aren't just selling used cars. They're selling actual
emotions, facts over feelings.
Exactly, facts over feelings, giving you the actual knowledge, because when you do that, you can actually advise people correctly and help them financially, which is what we should be trying to do as real estate agents, because they're buying very expensive houses at $500,000, and they should get the correct information. As far as, we can talk about ARMs if you guys want to. What are ARMs looking like right now?
They're a little lower. I think Mortgage News
I've
Daily
been
has
working out a lot.
7
I have not.
So
My arms are ready for
Their
the game
arms
tonight.
are jacked. I was climbing with Josh on last Thursday, and his ankle sprained, so he can't use his feet. If anybody's been climbing, you're supposed to use your feet when you climb. He now, when he's holding on to the pegs on the wall, looks like Spider-Man. He's just floating in midair and
He
moving.
just
and
ate a bunch of bananas.
It
before he
looks
went up there.
wild.
Just so many
just a
protein
straight
shakes.
up
The arms-
mon-
the
just
arms
a
are there.
monkey on
I
the
definitely
wall.
have the
Yes,
weakest arms right
I
now.
love
so
it.
much spinach.
AJ's been working out a lot as well, and I have not been. Sorry. Arms.
Tangent.
Adjustable rate mortgages.
Mortgage News Daily. What do we got for the 5-1 arm?
Let's
average
clip
rate?
that. Can we clip that Josh story? That one should be posted.
That's a good one.
or cut out. I don't know.
Mortgage News Daily has the 5-1 arm at 7.25 right now. It's improving. The big thing is when the yield curve is steeply inverted, that's not an awesome option usually, according to my go-to lender, Gus, just because short term is uncertain, so they don't give you as great of a rate on those.
You can get 5-1 arm right now, and instead of getting a 30-year conventional at 8%, you get 7.25%, and then in the next 5 years, if it goes below that, you can refinance out. It's not a horrible option.
No.
Not at all.
0.75% is a huge spread.
Yep. It's a pretty big spread. So
There's
they're getting a lot better as the yield curve continues to uncouple. I think you're going to see those rates get much better.
These are going to start becoming options, so I'd speak to your lender about it. I would say that's a very basic scenario. Sometimes you got to pay. There's points. There's other things that go into this sometimes that could make it less.
Get a good
advantageous.
lender.
Get a good lender. The last thing I want to talk about is what we're thinking about next year with where we think rates are going to be and what we think that's going to do to the market, specifically Q1 through Q2 of next year. The projection I think right now is rates are going to be about the same.
They
right
were. I mean,
then as
they're
are
showing
now,
them down
the
a little
30.
bit. Depends on who you ask. The Mortgage Brokers Association always has the lowest expectations because, it's wishful thinking
Sounds
a little
like
bit.
something
I think
they'd benefit
NAR's
from.
saying maybe 7% by the end of the year or something.
Yeah,
high sixes.
MBA had 6.4 by the end of the year. I think the last time we looked at this, Luke and I were looking at them projecting like 5.5, and we were debating that, and we were, less optimistic that rates were going to fall that aggressively. I'm still more in the pessimistic camp. The signaling continues to be that the Fed is going to act very, very slowly to pull anything back here, and they're going to continue to do what they can to keep things, slowly humming along and getting where they need to be. They don't want to pour any sort of fuel on the economy right now just because they don't want it to heat up too fast.
So let's say they're 7 to 7.5. That seems like a pretty conservative number. I mean, they could be.
Which sounds crazy to say, right? 2 years
crazy.
ago, if we were like, yeah, it's going to drop to 7.5, we'll be like, what? Wait, what?
How did that happen? I just want. What's your outlook on what Q1 and Q2 will look like in this market? We're in the Twin Cities market in Minnesota. The last 3 years since COVID, January 1st has
busy.
become chaos. Right? Multiple offers just about everywhere.
Yep.
Stuff going for above list price. If rates haven't pulled back as much as we thought they were going to, do we think that buyers will still enter the market at high enough clips to create a marketplace like it has looked?
First time home buyer markets will probably still be pretty active, I would guess. I think you're going to continue to see the move up markets be super slow.
Yep.
I mean, it just doesn't make that much sense to be a move up buyer when the wider the spread gets, the worse that decision point gets. I mean, if you have 2.75 and it was 6.5, you're like, this is terrible. Now it's 8. So like, why would you do that if you didn't have to? So I think people's movements within school districts, specifically here in Minnesota, will continue to be extremely slow. Some people, maybe they own a small house and they're having their second kid and they need to do something that might, make people have action. I think there's always real estate being bought and sold for that reason, but those first-time homebuyer markets probably will still have some action in them. No inventory.
And investors will continue to be slow because the rates are really clobbering investors. I think AJ's spot on with the way he's thinking about this. The only thing I'll say is that the longer the rates stay elevated, the more people will talk themselves into making a move, right? So as they continue to go up, people just are like, well, forget it. At some point, though, we've had this conversation with some clients where they go like, well, yeah, I get it. It's not ideal, but it's what I have to do right now. And the reality in their minds, which I don't know if this is necessarily poor thinking or not, but the reality is a lot of people are saying, well, once the rates come down, the buyer demand's going to go up and the prices are going to shoot up. So I run myself back into a similar situation a year from now if rates do suddenly drop down to 7%, right? If the buyer pool comes back, that should mean elevated prices. So if I can buy when the prices are a little bit depressed, then in theory, I can get the benefit of any sort of inflation that's going to come, or equity, all right, that's going to come as prices rise if buyer demand increases again. So it's tricky. I think the first-time home buyers, though, are always still left with that decision of do I buy or do I rent? And it's not like rental rates are decreasing right now. So
well, and I think you've seen too. You're right. If the rates start to slow down, it starts to get more normal. That will certainly help. One crazy stat is that the purchase index, which is just an index used to determine purchase mortgage applications, in 2021 it was the height at 334, and right now it is 129.8.
Really slow.
And
what was it in Q4 of 2022?
About 170.
And what was it in Q1 of 2023?
About 190.
Yeah, so
that increase was
you're always going to see seasonality, right, which is important to understand. I'm telling first-time home buyers that I'm meeting right now that are actually considering looking that this is probably the right time to be out in the market because the buyer pool is thinning out. We looked at numbers today, right, saying that the buyer pool in general is lower than it's been. And even though interest rates are not good, there's not a lot suggesting they're going to continue. They're going to come down in the coming year. So if you're a first-time home buyer looking to buy, January 1 is when we start to see all the people that have leases that are in the summer start to come out, getting ahead of this. So why not beat them to the punch by 2 to 3 months, even though the rates are not exactly what we want them to be? But there is the opportunity to, essentially. I showed 5 houses yesterday that were actually nice houses that have been sitting in the market for 2 weeks. It's just there's more out there than there has been.
I showed a 2-level split in Chaska on like half an acre on a golf course for $440, and it had like a brand new kitchen, dovetail, soft close, crown molding. Like this place was sweet. No offers. Went through the first weekend.
Yep.
I was like, that's surprising because I look back on the market. It's like there's nothing as nice as that one at that price point, and nobody's pulling it.
Yep.
It's wild. Well, that's all we have this week for the Nerdy Agent Podcast. As always, remember, be better.
Goodbye.